SanDisk crushed down a massive 12.63% in a single session. Mainstream retail tourists are screaming that the AI memory bull market is officially dead. But if you're only tracking the price drop, you are completely blind to the real macro catalyst. Auditing the tape, SanDisk wrapped the session, flushing 12.63% to lock in at $1,411.08. Concurrently, the SOX index bled over 4%, while the broader memory block surrendered 7%. This isn't a single stock miss, it's a sector-wide re-rating. Before we dissect how the Federal Reserve's hawkish macro pivot is aggressively hijacking tech sector liquidity, smash like and subscribe to track real-time institutional dark pool blocks and option sweeps. Hit the link below. The immediate retail panic assumes that corporate earnings or enterprise NAND microeconomics completely fell apart overnight. That's a total lie. The real selling pressure is being driven straight out of the Eclairs building. Fed Vice Chair Jefferson just dropped a major warning. While enterprise AI scaling increases structural productivity, the aggressive CapEx race risks overheating demand, directly fueling persistent high-level macro inflation. The central bank isn't just serving up oral warnings anymore. The Fed officially established a specialized internal task force to strictly monitor AI's macroeconomic impact, actively designating the tech spend boom as a persistent inflation risk. Compounding the local tape pressure, crude prices are bouncing on renewed Middle East geopolitical friction. Macro funds are defensively trimming leverage across high beta growth matrices to front-run systemic interest rate risks. Beyond the macro interest rate overhang, institutional desks are re-auditing long-term capacity physics. The Street previously prized an infinite memory supply deficit, but research houses are now modeling a flat balance by 2026. If cross-border factory expansions scale too aggressively, today's severe supply deficit flips back into a structural glut by 2028. Because the stock market discounts future terminal data, fast money is taking profits early. Yet the operational microeconomics remain wildly robust. KeyBanc issued a high-conviction print forecasting an aggressive 40% pump in Q3 enterprise NAND contract pricing, while projecting HBM target valuations to double by 2027. What is shifting isn't underlying cloud infrastructure demand, it's the valuation framework. Last year, the buy side blindly bought any equity mentioning AI. Today, institutional desks are strictly auditing real cash flow yields. After printing vertical extensions for over a year, the entire AI storage block had already priced in multiple years of forward growth. When localized macro headwinds hit the tape, high gamma positioning triggers massive flushes. This drawdown doesn't mean the sovereign AI infrastructure thesis is dead. This is a violent, structural repricing event. Near-term volatility will remain highly elevated, but hyperscale demand for high-density enterprise SSDs is locked. Checking the Bloomberg terminal, institutional target spreads for SanDisk remain highly resilient, spanning a defensive $1,200 baseline floor to an ultra-bullish $3,250 ceiling, maintaining a high consensus average near $2,111. Let's test your active technical conviction on this massive 12% storage correction. Is this liquidation an elite, institutional-grade buy-the-dip window, or is the high beta semi-tape heading down to fresh local lows? Comment below. To capture our real-time institutional entry clusters, automated options data sheets, and private workspace alerts to front-run the next advanced technology rotations before the retail crowd, tap the description links right now.